Welcome, class, to a video explaining some of the points having to do with our income statement, statement of comprehensive income, and the statement of changes in stockholders' equity. So we'll go over these three statements this time, and next week or next learning module we'll do balance sheet and cash flow. So some items that we want to review. Some of this will be review from earlier accounting courses. Obviously, you were taught in Accounting 101, income statement includes revenues and expenses, specifically revenues minus expenses. We also talked in Accounting 101 about gains and losses on the sale of assets other than inventory. In old rules, there used to be a provision for extraordinary items, which means that it was such a gain or a loss that was very much outside the norm, such that it was actually classified as extraordinary. The reading that I put in the learning module shows that that classification has now gone away. And so gains and losses are no longer extraordinary, but they are calculated a little differently, because when you sell inventory, we record the cost of goods sold and the revenue separate. When you record the sale of a asset other than inventory, you record only the difference between what you paid for it and what you sold it for. That is the gain or the loss. So there's one number instead of two. And that's kind of important in terms of understanding what you see on the income statement. Now, this comes into play especially when we deal with buying and selling securities. And I have a reading that I put in that's called Gains and Losses about how securities are classified. But real briefly, trading securities and held for sale equity securities, the unrealized gains and losses. So even before you sell it, even if they go up in value or down in value, those gains or losses are recorded on the income statement. Now, a new item on the income statement we probably ignored in the past was the concept of non-controlling interest. This situation is where a company owns more than 50% of another company, but not 100%. So as soon as you own over 50%, you are in control of that company. That means that all the assets, liabilities, revenues, and expenses are added to your financial statements. So they are included as if you own them all. Of course, that's because you control them all. You have the ability to determine where they go and what they're used for. So you add all the revenues and all the expenses on the income statement, since that's what we're talking about. Let's say you only own 80%. So you added in 100% of the revenues and expenses. So what you do is you subtract out the 20% that is actually belongs to someone else. So if you look at net income of a company, the net income is everything that the company earned. The net income attributable to our shareholders is everything it earned minus the small part that is owned by the shareholders, minority shareholders in that subsidiary. So that company that we bought, but only bought 80% of it, is that 20% of that particular part of the company. So that's when it is referred to. It's always the last thing on the income statement, or almost always the last thing. Another issue that we will spend some time on talking about looking at is discontinued operations. We'll practice this in our homework and in our example problem. This is a situation where we have sold. So non-controlling interest is about buying a company. Discontinued operations is about selling part of our company. This is not just the selling of assets. This is the selling of an entire piece of our company. And it has to be such that there is a strategic shift in our operations. That's the definition under GAAP. There must be a strategic shift. So, if that's the case, then what we need to do on our income statement is, so discontinued operations is a situation where operating results and the gain loss on the sale of a part of our company are listed on one line item, net of the taxes on that, on our income statement. Usually at the bottom, before the non-controlling interest, but at the bottom. And that is more described in the reading called Considerations on the Income Statement. Now, earnings per share calculation is net income divided by, that's EPS, net income divided by weighted average shares outstanding. Our abbreviation for that is WASO, W-A-S-O. That is a required disclosure on every income statement for net income. If there are preferred dividends, it is net income divided, subtract preferred dividends, then divided by the WASO. It must be calculated separately for any discontinued operations. That's our special item. So you're going to have a separate EPS calculation for discontinued operations so that the company reader of the financial statements can see how much effect on our earnings that discontinued operations had. And earnings per share is perhaps the most important number on the income statement, or at least gets the most attention, because it is measuring how much money the company made per share. So the shareholders, it's very much for the shareholders' information. Now, the new statement, the one that didn't come up in Accounting 101, was added in the last about 10 or 11 years ago, is a statement of comprehensive income. Comprehensive income is defined as all changes in equity not resulting from transactions with owners. So it's a broader measure than net income. So first you have net income, and then you have what's called other comprehensive income. These are things that are not part of net income but are part of comprehensive income. So we use the term other to make sure you understand that it is outside of net income but still part of comprehensive income. There's 4 items there. There's actually in your codification on comprehensive income a longer list, about 11 or 12, but these are the 4 that will happen most often. The one that we will see is the unrealized gains and losses on held for sale securities, at least debt securities. That's the example we will be using, but all of those could happen and you will see them. This statement is either at the end of your income statement or as a separate statement altogether. So it begins with net income. So some companies have their income statement down to net income and then start their statement of comprehensive income after net income. And then you add or subtract comprehensive income, other items of comprehensive income. And the thing to remember and make an asterisk is all items on this statement must be net of the income tax effects, meaning if you had a loss of $1,000 and your tax rate is 40%, then your loss is only $600 because you would save $400 on taxes because of the loss. So to look at what this looks like, we'll look at the next slide. And this is an example of a statement of comprehensive income. Notice that it starts with net income, or in this case a net loss, and then it has the different items listed that are part of other comprehensive income. And you'll recognize some of these from the list on our slide. And then you must consider the tax impact either on each one adjust it for the taxes, or as this company has done, separate the tax into like a separate section, however you choose. And then this total other comprehensive income is net of the tax implications. So the 130 loss, save $9 million on taxes for 121 total other comprehensive income. So the total comprehensive income is your other plus your net income. So the 82 plus the 121, both of which are negative in this case, so you add them together, comprehensive income is 203. So that's how it looks on the statement. Typically, most companies do it that way. Statement of changes in stockholders' equity. The rows on your balance sheet become columns on the statement of changes. So what it's measuring is all of the changes of the accounts in stockholders' equity. So some common ones that you'll run across, you usually have some columns named common stock, paid in capital, retained earnings. This stands for accumulated other comprehensive income and treasury stock. The things that change stockholders' equity, dividends, the sale of stock, and then of course anything that changes comprehensive income or other comprehensive income is also listed. So important to note the following. If we go to the next slide, we'll see a statement of changes in stockholders' equity. Notice that there is a column here for accumulated other comprehensive income and a column for retained earnings, or in this case, because it's a loss, accumulated deficit. Those are the two that we're going to look at most carefully right now for a second. Net loss or net income goes in this column, as would dividends. All right, they change the column accumulated deficit. The other comprehensive, this number, okay, the 121 goes in this column other comprehensive income, accumulated other comprehensive income. Notice this 203 goes nowhere because the 82 goes here and the 121 goes there. So don't try to put the 203 somewhere. The 82, the net income or net loss goes in the accumulated deficit or retained earnings column, and the 121 or the total other comprehensive income goes in this column.